Okay, Doug, we look at some of the labor market numbers that we've seen recently, and that has a lot of people pretty concerned. Those weekly jobless claims are closer to 400,000 than 350,000. Right. What's your read on what's happening, and what would it take to bring us out of this downturn?
Well, I think we're suffering from a very simple problem, which is if you don't have good trend growth, 3%, 3.5% coming out of this kind of a recession, you're subject to the fact, if you're growing at something like 1.5 or 2, that when things go bad, you can get knocked into very close to negative territory. And that's what we've seen. First it was tsunamis, and now I think Tony has a very good list of the downside risks. But the core problem is that something does always go wrong. I mean, that's the nature of economics. And the way you insulate yourself from that is to have better pro-growth policies and grow more rapidly on average. We're not doing that. And I think the fundamental big picture problem is that we have the wrong policy-making regime on both the monetary and the fiscal side. What we need are some deep permanent reforms in tax and entitlement programs and an exit from extraordinary monetary policy. We've been doing extraordinary monetary policy for 4 years.
You're throwing the Fed under the bus?
I think they've done a very good job on a day-to-day basis. I mean, there's no question about that. But, if you look at where we are, what the Fed did yesterday was say, look, we're going to extend current policy. And I think that was the right call in that, the markets were expecting more aggressive policy, and I don't think that was merited. But they did also set the stage for a QE3. They marked down their forecast. They said, we will move if circumstances warrant. And I'm afraid that markets will now price in an expectation that at the next meeting there'll be a QE3. That's not warranted unless there's a serious downside shock. And that puts us in a position where if you step back, that might be the right thing to do day to day to play the contingencies, but it means that they're in a position 4 years out of still using extraordinary monetary policy measures. Something's wrong when you're in that position.
Granted, but Tony, is there really a way that the Fed can say we're not going to act if there is a downturn? I mean, Doug, maybe we're splitting hairs kind of looking at what they said, but if there is a serious downturn and you look at what the...
Isn't that the nature of Fed watching? You split hairs?
Yeah, but if you look at what's going on with Europe, you can understand the desire to feel like you still have something you can do.
The sense of activism
I agree with that.
Has helped the markets and hence the economy.
I agree with that. I think the Fed has a very important role to play in insulating against downside financial shocks. That's where its bullets remain. But there's not much it can do to push growth at this point.
All right, Tony, when you look at it, I mean, obviously he's right. We're going to be looking at everything the Fed says and what they do down the line. They did extend Operation Twist. That's kind of what the market was anticipating with the thought we'd get more. Do you think we're closer to QE3, or did this push it back on your radar
screen?
Yeah,
we do think they are closer. The Fed, though, has been weighing the benefits, costs, and risks, as Mohammed El-Arian tends to point to what Ben Bernanke once said. And the costs and risks are growing. One can point to the impact on savers, for example, or the impact on pension funds, or the dislocation, misallocation of capital, the malallocation of capital. The Fed has three objectives in its current policy. One is to so-called flatten the forward curve, which is to push out the date at which people expect a rate hike. Secondly, to lower interest rate volatility, which is a way of bringing down the term premium in bonds, which is to say the amount of yield that people want to demand for uncertainties about Fed policy. And third, push investors out the risk spectrum so that they buy riskier assets, and that, of course, boosts wealth and boosts consumption. But there's only so much that can do. As Doug says, what we ultimately need is investment in research and development, education, infrastructure, and reducing uncertainty, et cetera, so that people put their money to work and we get a better economy in the long run.
Let me get back to Doug, because we're going to lose him in a minute. But Doug, when we take a look at what's happening today with some of the Eurozone countries meeting, and then next week is the big meeting between all of them, what's the upside-downside risks here?
I think it's very hard to see a strong upside risk, and that's a troubling aspect of the current situation. There's big downside risk. I mean, what we've seen in Europe on a regular basis is a tendency to not really resolve problems, to kick the can down the road, to sort of temporize. And my fear is that we will see that again, and that would send a very bad signal to markets. Yeah. And that's something I think people are on alert for.
All right. Doug, I want to thank you very much for joining us today. We'll be on the lookout as well. And, of course, Tony's going to be with us for the rest of the program.
Okay, let's walk you through some corporate headlines this morning. Monster Beverages, well, they are going to become the newest